Good afternoon and welcome to the Future of Finance, where today we will discuss security token markets need issuers and traders even more than investors. I shall now hand you over to Dominic Hobson and the panel. Thank you.
Hello everybody and welcome to our webinar. Security token markets need issuers and traders even more than investors. I'm Dominic Hobson, co-founder of Future of Finance, and I'm delighted to moderate our discussion this afternoon. How long, O Lord, have I cried unto thee unanswered, asked the prophet Habakkuk back in 600 BC. 2,500 years later, we're still awaiting the arrival of divine justice. Let's hope we don't have to wait that long for the marquee security token issue that will tip the security token markets into a sustained period of exponential growth. I know at least one of our panelists thinks we've already had that marquee issue. But luckily, what the security markets needs is a lot less demanding than divine justice. They need investors, of course. They need issuers even more. But what they need most of all are traders. These are more important than issuers and investors in a way because it's issuance and the traders and the liquidity they bring, which will attract more issuance and so create more liquidity. Security tokenization, in short, is suffering from a familiar form of impossibility. The prospect is alluring, the solution is obvious, but the problem is the absence of the solution. Now, to help us find ways around this trilemma, I'm joined by 3 experts in tokenization, in fact 5 experts in tokenization, who from their very different perspectives have been addressing the need to find issuers, source liquidity, clear regulatory obstacles, and get the token markets going. Olaf Ransom is head of the CSD function at SDX, the integrated digital asset issuance, trading, settlement, and custody platform owned by SIX Group, the Swiss financial market infrastructure provider and operator of the Swiss stock exchange. Lars Holst, who worked for many years in the FX markets, is the founder and CEO of GCX, which he founded to meet the growing demand from financial institutions for access to cryptocurrencies. Mark Smith is from Symbiont, and Douglas Borthwick joins us from INX Limited. Now, I'd like to start our discussion by asking the basic question here. We're going to talk about issuance. We're going to talk about trading. And my question, it can be summarized really as, where are the issuers? After all, tokenization ought to be a bit of a no-brainer for the issuers. They've got reduced issuance and listing costs. They've got access to a wider base of investors, should make their capital cheaper. They also hopefully will get lower asset servicing costs. Their corporate actions will become easier and cheaper. And they also get much greater flexibility in the instrument itself. They don't have to sell ownership rights. They can sell slugs of profits or slugs of revenue and divide the ownership rights from access to the revenues themselves. So my question is, where are these issuers? A lot of the issues, and bear in mind, this is an area of the marketplace where data is difficult to find. Accurate data, comprehensive data is almost impossible to find. But what I've been able to look at, I find that a lot of the issues have been more like private placements than IPOs, particularly in the US. They've been Reg A, Reg D issues rather than equivalents of initial public offerings. A lot of the early issues, this is changing a bit now, I know, have been for token infrastructure providers themselves, looking to fund their own businesses. And we've seen issues in real estate. Some of those are a bit less than meaningful. In other words, what's getting tokenized is not the asset itself, but the income stream. Debt has been highlighted as a very interesting and potentially high growth area. We hear a lot about the EIB issue, April last year, which was a tokenized bond on a public blockchain, but even that seemed to have many limitations. We've heard a lot about privately managed assets, private equity, private debt. We've heard a lot about collectibles. Fine art is one thing. We're now even starting to see moments in sport, but even that seems to be getting captured by NFTs rather than by the security token markets. Lastly, and I did a webinar on this last week, tokenization of the mutual fund markets do seem to be getting going now. We've got a couple of startups who are having some success in that area, actual funds being tokenized in Asia. So I'd like really to throw this question first at perhaps Olaf, you could kick us off, but I'd like Henry and Douglas to contribute to this as well. How difficult is it to find issuers of security tokens?
Well, SDX did that first bond back at the end of last year, and we were lucky enough to have Six Group as the issuer. And you need that volunteer to be first. For the investors, ultimately, those bonds ended up in normal portfolios at normal banks, particularly in Switzerland, where we have universal banks and clients have both their checking and banking and their securities with the bank. We needed that for everybody to see that it could be done, and for other issuers now to come to SDX and in conversations with us say, yeah, we'd like to do another bond. It's a while before you can pick up all the benefits of issuing bonds. I think if you were to misuse the phrase by Rod Stewart, the first step is the dearest. You have to ask the banks to set up some new infrastructure. For the banks, it's just a pain at the margin. It's a pain in the neck to do, but you can start to see that pressure. You've got more issuers coming. You've got issuers who come and say, well, actually, what we really want to focus on is the whole pre-trade coordination part, and I know the primary part, and Mark will have some words to say about that. How does the issuer get together with the banks and the syndicate to say, yep, this is the deal we want to do, who's taking how much? That there seems to be with the issuer saying, I also need you to do that. So, yep, slow train coming, but you have to take that first step would be my point on that. And I'd also say, from looking at the other things that are floating around in and around SDX, there's a lot of interest in debt, of new instruments, of different flavors of, for example, supply chain financing, commercial paper, which Mark talked about in the warm-up that you're seeing. So we needed the signal. That's got people interested. And there's more to come.
Thanks. So now, Douglas, you're the Chief Business Officer at INX. You're based in New York. You've got this cryptocurrency trading platform. You've even got a digital asset broker dealing business inside the firm. You've got an automated trading system. You've got an interdealer broker. You yourself have this long background in FX trading. Am I right to be less than optimistic about the difficulty or ease and difficulty of attracting issuers?
I think you're wrong. The issuers are staring us in the face. There are a lot of public issues already that are trading on exchanges or ATSs. There's 13,000 companies that trade on the OTC. Now, the SEC said about a year ago that they see all assets moving onto the blockchain. So there's 13,000 issuers right there, and we're working on a factory that's going to take them and do a token for equity for token swap and then list them on our exchange. So that's something that's pretty exciting. But on top of that, the issuers are out there, but you need to use imagination. There's only so many real estate companies that want to tokenize an asset. We've got a sports team that we announced a couple of months ago. ALK Capital owns a Premier League soccer team in the UK, Burnley. And we're going to do a raise for those guys and do a security token for them. That's going to be pretty exciting. And that's someone that's got a heck of a lot of people that want to invest. You talk about how do you get people and how do you get liquidity? Well, you list things that people want to trade. If you list a $20 million piece of real estate and you only sell it to accredited investors and it's only 1,000 of them or 100 of them, there's not going to be a lot of trading. But if you list things that have an underlying that's volatile, let's say against gold or against oil or Bitcoin, these types of things are going to have volatility. There's going to be a lot of people following it, and there's going to be a lot of excitement. I'd say we've got about $3 billion of issuances that we're expecting to do this year, with the Premier League being one of them. But there's a lot more of interest. And I think that what you need to do is you need to find out, how do you thread the needle? There's different tax jurisdictions all around the world, and people pay tax for crypto and they pay different tax for securities. If you can have a security that gives you the same sort of benefits that crypto would, or the same movement, but at a much lower tax rate to certain countries, that's going to be pretty interesting to people. But I think that a lot of the time, imagination hasn't been put to work. I think people looked at security token and said, well, that means it has to be securitized by something. Let's do real estate. And the way we look at it, INEX, we did the first ever IPO of a security token. We raised $85 million from 7,250 people in 74 countries. And we did that because we wanted to prove that if you can get retail involved from day one, then it becomes very exciting. Now, we talk about Reg Ds a lot in the United States for private offerings, but I do think that Reg S is going to become much more important. With the Reg S, you can sell to retail, around the world outside the United States. And so I think that you're going to find that there's a lot more Reg S. A lot of companies will come out with Reg Ds, but they'll come out with Reg D, Reg S. So they can only sell to qualified investors in the US or accredited investors. But outside the US, you can sell to absolutely anyone, as long as they pass through the KYC AML and come from the right countries. But I think that that's going to be sort of the moment. I mean, I see liquidity being there when you have retail involved. And how do you attract retail? How do you attract the audience? Well, you have a cryptocurrency trading business. Cryptocurrency, everyone knows. Security tokens, it's a bit of a mouthful still, and people have to get educated to it. But once they come into my shopping mall because they want to trade Bitcoin, or they see me at the Daytona handing out a trophy, then they come in and they say, well, what are these security tokens you're offering? And every security token that I offer is going to have a community attached to it. Whether it's 600,000 people or 1 million people that already are familiar with the product or the company, that's the type of thing I think that builds community, builds trading volumes, but also builds interest in what you're doing. I think that early on, guys that got into this space thought, what, we'll list some real estate and that's going to get a lot of excitement. But it doesn't get a lot of excitement if it's only sold to accredited investors. You need to have something that's got sizzle. And if you don't add things with sizzle, then you're not going to be successful in this business.
Thanks, Douglas.
Well, in the US, there's a huge problem with regulation. And Dominic, you start off by saying, when are we going to move away from private into public, something more of an IPO? Well, there's a huge restriction in the US as it relates to the form in which securities take in order to go public. They have to be DTC eligible. There is no such.
That's true. The INEX token is a public security with a full F1 prospectus sitting in the Edgar database. We're publicly reporting. We do not do anything with the DTCC.
So that's not an S1 filing. That's not an IPO.
F1.
That's an alternative. That's an alternative to the traditional.
An F1 is a foreign filing, as opposed to an S1 being a domestic filing.
Correct.
But we did the first ever IPO in the United States of a registered security on the blockchain.
And that security is not considered a traditional issuance in the US under S1 as you just described, right? So if you're looking for a wave of issuances, right, we have multiple rules and regulations in which we have to address in order to be able to attract those. Similar things, for example, if you want to expand to retail, you then need broker-dealer networks in order to facilitate retail.
Or you can onboard retail directly.
Onboard retail to a registered broker-dealer in the United States who's registered to sell public securities, right? We need ATS. I'm not saying you're not, Douglas. I'm saying this is what's needed to get there, right? So INX is a teeny little drop of something starting, but it's not the way in which you get a wave to crash over and to be really something where tokenization actually becomes real, right? And so we've been working on this since 2013. This was our first use case when we started Symbia. We spent 3 years in the state of Delaware changing the law so that the place in which you incorporate in the United States is the place that actually governs the rules and regulations of your security. So 85% of all companies incorporate in the state of Delaware. So Delaware law was changed so that a blockchain, distributed ledger, could be the sole books and records of a company. You could file there and incorporate there and create any structure, right? So from that structuring in the US, then you need to take the next step of, okay, now that I can legally do this, how do I do it in the form of a securities offering? Whom can support those securities offerings? What kind of infrastructure exists? How does it get promulgated against the national market system? And if you don't have a security at the DTC, it's not part of the national market system. So you're in a secondary part of the market system. So what we're really saying is that there's a lot of barrier in order to be able to actually start issuing these things wholesale, transitioning them from one type of promulgation, uncertificated, dematerialized securities, or in the worst case, an actual physical certificate, into a token-based solution or a smart security, as we call it, and then have that execute through the national market system. right? We're nowhere near that infrastructure creation yet, and we don't have enough participation, and we don't have enough incentive, right? When you look at what's happening and where the money is flowing in our marketplaces, the money is clearly flowing into the crypto world. It's flowing there through the VCs and the infrastructure and all those pieces because it's a direct access point into distribution. If you look at what we're trying to do in the securities market, there's very little incentive because, as Dominic started off, it's hard to quantify what the real savings are. It's hard to quantify what that's going to mean across different types of assets. Debt is very different than securities. Now we have the new securitization of physical things, and I think you're right. We were very distracted by things like real estate, which was never going to be big. That's never going to be the largest market, right? You have to have sizzle, as you said, Douglas. You have to have issuers who want to come out and issue real things at size too. And markets, small issuances isn't really going to help this move. You need size issuances in the traditional size to be able to go out and execute. And the bigger issue we have is that now on what markets will this operate? Because now you're trying to build out markets that are compliant. And in this case, you would need an ATS if we're talking about trading these new securities, right? So that's a trade against a regulated ATS. And that means that the regulation around it, right, as a BD, connecting into and all those AML KYC pieces gets you farther and farther away from the core constituency that trades aggressively in crypto. So we want to say there's an analog between crypto and security tokens, but there's really not. There's a huge differentiation in the middle. The crypto market is a global market which is operating relatively unregulated in a way in which any potential trader can go access these types of instruments and trade them. Whereas in securities, you have geographical regulation that you have to deal with. So country to country is looking at them differently. So we don't have a global issuance that everyone can swarm around and create global liquidity. You have liquidity broken up into pieces. And then you have the underlying infrastructure, which is being operated in the crypto world through blockchains in which there's incentives around staking or mining. And then you look at which of those solutions can be used compliantly in the securities world. And that's a very difficult thing to answer at the moment. So then the platform itself, if you move to something like we offer, which is an enterprise version that doesn't have crypto economics, now you have to have incentives for participants to run the nodes, to create a decentralized environment, to be able to issue onto natively, and then in turn be able to transact from there. So there's a large amount of barriers that are created in order to get there, not to mention, how do you settle from a cash perspective? Olaf can answer that from Finality, right? The big 800-pound gorilla is, you've got a security token on a ledger. Where's the cash portion? Where's the consideration for the transaction? So we don't have enough actual cash that we can use to settle at the moment in a legitimate way where we can have a fulsome network with a lot of issuers and traders, new issuances, and a way to transact and settle these things. So there's a lot of work to be done to get from here to there. And I think it actually needs to be done by the institutions first, because the institutions will create the infrastructure that in the future you can layer retail on top of. So, we started with someone like Ford. So we did a pilot with Ford for a $1.3 billion ABS that was completely automated, issued by Ford directly to investors in a new structure where it exists natively on a blockchain and is executed as a smart security, which means that it automates the cash flow process through Finality. We're now going to do a live issuance of commercial paper. And again, institutions are looking at this and saying, what's the lowest level of risk? So commercial paper is a short issuance, right? What is something that we can distribute to institutions without a regulatory issue, right? Commercial paper or something like that. And then how does it work, and how do we then distribute it, and how do we then layer from there and grow? So it's a huge issue. It seems obvious when you look at it, but then when you start to peel the onion, it gets more and more difficult as you go.
Mm-hmm. Thanks, Mark. I'll come back to that institutional point, but I'd like to bring Henry in at this point. Now, Henry, you're the CEO at Fusang. You're a full service exchange. For tokenized securities and cryptocurrency, you're licensed and regulated in 2 jurisdictions. You heard Douglas say that one of the ways to bring liquidity to the securities markets is through that cryptocurrency enthusiasm. You heard Mark say something slightly different, but give us a perspective, an Asian perspective, if you like, on what's really happening in security tokenization, because I'm sure it'll be different from what's happening in Europe and the US.
Absolutely. No, thank you, Dominic. And first things first, I think I am the only person here representing Asia, and I'll caveat everything I say by the fact that I have very little knowledge of how US securities laws work, except to know that it is very, very complex. Maybe just a little bit of background about Fusang as a group, because I think that we think about the security token markets quite uniquely and sometimes quite controversially. Fusang, I think similar to a lot of people exploring the security token space, realize that you really do need to provide a more holistic ecosystem than what a lot of traditional exchanges are looking at doing. To us, it is important that we can issue tokenized list trade securities beyond just what a traditional exchange function might do. And I do think that it is very important to try and blend both the traditional world of capital markets and securities, and I'll talk about what that means, while also grappling with this whole digital crypto world and etc. Maybe talk a little bit later about how we put together some of these pieces and the infrastructure. But I think one thing that we've done very uniquely is, I agree, retail participation is absolutely important. I don't think you can have a market that functions without retail flow. You have a lot of institutional markets that exist in the world, but most of them at some level are layered upon retail access. So most of the flow in a market might come from an institution, but I do think you need some degree of retail flow to make everything go round. And that's why when we were first looking at this space, I was very, very clear that we needed to build an actual stock exchange. We needed to be able to take very traditional looking securities, bring them through a very traditional looking IPO process, turn these into public companies where they could then do retail offerings of their stock. I personally think security tokens as a broad category, some of the things you mentioned, Dominic, let's call them investment contracts, derivatives, etc. Very, very interesting. My personal feeling is that that will not be the first step in the security token market, that we need to begin with instruments that are simpler. And I'll again caveat this by saying, I think there'll be lots and lots of dimensions of the security token markets. We will be tokenizing commercial paper. I know of a lot of people here in Asia actually doing some very interesting things around real estate. These are all very unique asset classes, markets, unique features. But if we're talking about flow, the sizzle, as you say, the retail investors, the really big numbers, the way that actually we've begun to be used to in the cryptocurrency markets, I think that that will come from equity offerings, and it will come from companies that have those stakeholder bases, as Douglas was saying, companies where people say, yes, I would love to be able to buy their equity. I cannot buy their equity today, or I cannot buy it in a digital format that I'm used to. And if this is the way, I won't even really care about the technology. I'll just care about the access that I can get. I think that it's very easy to, I think the security token markets often, it's very, very dangerous to build products that then go in search of a solution. I think we see that all the time. I think a lot of us come from capital markets backgrounds, and we have ideas of how the market might be able to better function. And so we try and build that and hope that we can then fit that into the world and that there will be demand. And I don't think that's always the case. And I think that what we need to look at in the security token markets is to start by learning from actually the cryptocurrency markets. And I believe that at least when it comes to these kind of publicly traded tokens that we're talking about, we need to be able to understand what are the drivers of the cryptocurrency markets today, while layering that on top of very traditional looking securities. So can we take an equity of a company, a normal share, issue that directly on the blockchain, not as a stable coin or as a derivative or investment contract, while still being able to open up access to retail investors using some of the same principles that you're used to in cryptocurrency markets. DTCC access is one, completely agree with that. The ability to trade directly, to be able to transfer assets around. I think these are all some of the, I wouldn't call them principles, but I think some of the key drivers that have made cryptocurrency markets so large today, to the point where I think they are unignorable. Again, I'm sure everyone on the panel knows this, but maybe for some people in the audience, I suspect that people from traditional finance, or TradFi as we like to call it, don't fully understand how big the cryptocurrency markets have gotten and how wide participation has been. 24 months ago, quite frankly, crypto was a fringe curiosity. Today, here in Hong Kong, for example, where I'm sitting right now, if you're under the age of 25, 50% of your investment portfolio is likely to be in cryptocurrencies. If you're under the age of 18, 100% of your portfolio is in NFTs because you can't buy anything else. And I don't think that you should underestimate just how much crypto and NFTs and etc. have exploded into the public consciousness. That said, and I'm pretty sure all the panelists here would agree with me at some level, the crypto markets are very messy. When you look at the kinds of assets being traded, again, you have Bitcoin, Ethereum, fantastic. When you start to look down that list on CoinMarketCap, very quickly it becomes a bit more adventurous, let's say. And I do believe that being able to offer just very boring, understandable securities like shares, equity to that market is the way to go, as long as those shares are in companies that people really, really want to buy. So I think I agree with you, Mark. You know, it's real estate, maybe not the answer, but I don't think it's the asset class. I think it's offering a token to investors and saying, I've got a 4% yield or whatever it happens to be. And we know this from firsthand experience because end of 2020 now, we were trying to issue a bond. You could call it commercial paper with China Construction Bank. Effectively, is a short-term 3-month US dollar deposit on their balance sheet, paying 75 basis points a year USD yield. And back then, everybody got unbelievably excited in the fact that we could tokenize something like that. I guarantee you, if we were to try and issue something like that today, nobody would care. Nobody would get out of bed for 75 bits. Everyone wants to trade Bitcoin and get crypto yield. So I guess what I'm trying to say is we've got to blend those two worlds.
Yeah, Mark, could I just stop you a minute? Because I can see it's a fun discussion, but I just wanted, we're getting some questions starting to come in now. And I also wanted to give Lars a chance to say something as well. And on the questions, I obviously encourage everybody watching and listening to put in questions, use the Q&A to send in your questions and comments as we go along. But Lars, I'd just like I'm going to come back to you, Mark. I'd like to bring you in, Lars. Now, we've had a question here actually from Paul Dowding, where he says trading of any securities, particularly bonds, requires a financing borrowing market to complement it. You know, basically repo is the source of liquidity in the bond markets, as he's pointing out there. But current blockchains cannot record future dated obligations as payables and receivables and usually rely on smart contracts, which are algorithms that only wake up and process fully paid for long transfers. Aren't these some of the problems hindering liquidity and trading? Lars, I don't necessarily need you to address the technological question, but it seems to me that trading, this ought to be very attractive as a trading market. You've been trading crypto for a while now. The opportunity to trade equities, if you like, and debt round the clock, use those cryptos as collateral. To Paul's point there, you get more asset classes to trade. You're going to need less capital and cash to do it. The kind of liquidity depends upon people like you. What is your view of the security tokens markets? Are they an attractive trading opportunity yet? And are they one in future, in theory, something you're going to get really involved with?
I think actually, if I was to choose between the three panelists, I'm probably more siding with Henry on this one. I think the first two panelists, they probably highlighted, to me at least, that this is really complicated from a regulatory point of view. And I'm sorry, I'm not an expert in US regulation and legislation myself, but it's a minefield. I was fortunate enough last week to announce that, you know, I sold part of my company to one of the investors in Sandbox, and you know, Sandbox, GGV from Singapore, in case you missed it, and you know, they are all over the place with NFTs. So I'm educating myself. I have a course actually tonight with them on NFTs, and you know, coming from the strict regime of the FCA and the guidance, they continue to have these consultation papers. And I'm sorry to bore you with the legislation and regulation, but you know, security tokens, of course, is a MiFID instrument. So we just fall under. We have to be super careful, me at least, under the FCA, and that's probably the biggest problem I have, that to you know, really flogging security tokens, because I love anything weird and wonderful that can move and the clients they can trade. But I think some of what some panelists probably thought should be on a security token, I actually think it should be moved over to an NFT, because then it's an unregulated product, much easier to deal with. And then, hardcore regulated instruments should probably remain as security token. And I actually also think that instead of issuing something weird and wonderful, why not take traditional products, as you say? I coming from traditional finance, CDSs, or coming from the UK, where we've grown up with CFDs for years and years as the leverage, an instrument instead of trading the underlying. That would be a shoe-in for me to move the whole CFD trading world over to security token. I think that's really what the new generation they want. As Henry he said, in Asia, by virtue of TGV, I actually also have an office in Singapore as of last week. So out there, they're more, how to say, open-minded from a regulatory point of view. It's also easier to get into the fiat rails. Again, I don't know how easy it is to get high street banks in the US. I can tell you in the UK, it's close to impossible. You need to go to mainland Europe, Germany, Switzerland, or in Asia, it's also quite easy actually. So I think security tokens trading on traditional instruments, to me at least, from a broker point of view, makes super perfect sense. And I think we can also see the volume. And as the broker, at the end of the day, I make a living of the volume and the broking. It's not super interesting for me to list something that's super illiquid, aching penny stocks, where I can't make commission. I'm sorry to say, that then we're back to it's the first panelists that have it make it interesting, where they are involved in the issuance and the whole value chain. But for me, as the broker, FCA regulated, and on the FCA crypto asset register, by the way, I of course need something that moves and where there's volume. Also, as Henry said, I also get asked for listing weird and wonderful exchange tokens, and I always look at the coin market cap or something like that, top 20 coins. It's like in foreign exchange. A lot of people, they'll come and ask, for local markets, ruble, Mexican, and then you ask them, how much are you going to trade? Well, I might trade 2 trades a month. Well, sorry, sir, it's not really worth it. And 70% of the business, if you just cover euro, dollar, sterling, and yen, maybe some Swissy today, then you have 98% of the volume covered. Okay, then leave the rest to some specialists out there, and I'll have the same approach on the security tokens. I'm sure there'll be some penny stocks player or whatever they'll be called in the future, and then I guess I at least will need to focus my energy on where I feel it's transparent, where I'm comfortable with the underlying AML and KYC. And of course, where I can make some commission at the end of the day, and that of course is a function of volatility and volume. So sorry, that was not exactly your question, Dominic, but I just thought I would just
no, it's very helpful. One of the points you're making is about building bridges between the world you're trading in now and the world we could be trading in the future. And Olaf, perhaps you could address that in a minute. Before we do, could I ask Douglas and Mark to address this question, which has been raised by Andrea Tranquillini. It's originally for Mark, but I think, Douglas, you'll have thoughts on this. He says, if most of the companies are now incorporated in Delaware and the law has been changed, is what you were saying, Mark, what would be the trigger for tokenized issuance? Is the DTCC lacking readiness to handle securities tokens? So, Douglas, perhaps you could answer that by saying why you didn't bother with the DTCC, and Mark, you could address Andrea's question more directly. Is the DTCC an obstacle here?
We went to the New York Stock Exchange and NASDAQ. We said we got a full security, it's digital, we'd like to list. They said, look, we're not ready to. The DTCC, I guess, is kind of like it's the kitchen, and New York Stock Exchange and NASDAQ, I guess, are the restaurants. So we had to bypass it altogether and list it on an ATS that we bought. And a lot of digital assets have to go that route because the DTC is not fully prepared yet for what's happening. And yes, we miss out on the ability to access all of the networks that happen when you go through a national exchange But if the national exchanges are ready, then maybe the network has to change. You can't put a square peg through a round hole. And I think that in the future, maybe you don't go through a broker and then go onto an exchange. Maybe you just deal with the exchange directly. And I think that, that's certainly the way that people are trading crypto right now. And that's certainly, I think how a lot of people are looking at it. And so our view is, look, let's just onboard people directly. We'll bypass the DTCC if they're not ready for us. And, sometimes you don't have to worry about the current system. The current system certainly has a lot more breadth and a lot more distribution, but sometimes you've got to change that, and you got to change the way that distribution happens if you want to be successful.
Yeah, Douglas did it the exact right way, the only way. The DTC isn't ready, the exchanges aren't ready, the custodians aren't ready, the brokers aren't ready. No one is ready, at least in the United States. I can only speak to the United States. There is no institution or part of the current system that is ready, period. And then there are different pockets of effort to change things. The DTC has two initiatives going on right now, in which they're looking at this technology and how to potentially do something. One purely in the private markets that they're driving themselves, where they're looking at how do we get private securities on a distributed ledger and as a test market to see, because it's less risky than public securities on a distributed ledger. And then you have Paxos kind of leading the way with a no action letter, where they're in fully S1 securities, a small group of them with a small group of institutions and a small amount of volume, settling trades in a shorter period, but they still have a DTC account that's part of the process. So this is all just baby steps into what may be something bigger. But we see the Delaware law eventually clashing with federal rules and regulations, because there is a requirement, if you're going to be a fully S1 listed security in the United States, part of the national market system, you have to be DTC eligible in the form of your security, which really means you have to take the true property right ownership of a private company, cede it to Seed & Co., all property rights, and then in turn, they reissue contractual rights back to the companies through the custodians and the broker-dealer to the end investor. So that whole structure is designed to try to create electronic records, and it requires centralization. So coming with a decentralized concept really dramatically changes everything. And then when you start to talk about, well, then what's going to be on those ledgers and what's the first issuances? I think, Henry, when you think about 18 to 25-year-olds, and you're exactly right. The problem is, outside of that top 10, as Lars pointed out, in the crypto world, those would all be considered highly speculative penny stocks in the United States. They wouldn't even be in the national market system. Most of them would be in the OTC space, even downlisted. And so therefore, you couldn't use it as collateral. So the idea of a sushi swap or a uni swap or any of these things that happen in DeFi absolutely unequivocally couldn't happen in the US, because you're leveraging a penny stock to buy a more risky penny stock. That just doesn't happen. And then there's the whole AML KYC and the prudent man rule, where the broker dealer, and Douglas, you know this, right, has to be responsible for the traders. And you have to stop people from doing things that may hurt themselves, even if they want to do them. So those who could trade these very speculative stocks, if they became security tokens, would be limited. So those 18 to 25-year-olds probably wouldn't be able to even trade them, because they wouldn't get past the initial their initial process of AML KYC. So there's just so many things that exist. Douglas is 100% correct. We have to scaffold up a new marketplace from the ground up with INX and others, and we're gonna have to build systems and processes and have it as a basically a competitive marketplace to the traditional market. And then over time, you could see issuers move because of the value from the current systems to the new systems. But that is a long process. And I think if we look at crypto and say, well, that's where we want to go, we're probably never going to get there, because those crypto issuers spend all their time saying why they're not a security. And absolutely fight hard to say they're not a security, so they avoid these rules and regulations. And Lars, the problem we have with NFTs now is, in the US, they're looking at them and saying, that's an investment contract. So you don't have to call it a security, but that's an investment contract. Therefore, you fall under securities rules and regulations, because you're only buying that NFT to trade it in the future for value.
If I could add something to what
go
Mark,
ahead, Douglas.
one thing we don't talk about here is custody. And custody is something we need to get around as well, because there's no qualified custodian for digital securities. Now there is for digital assets like Bitcoin, Ethereum. You can go to Fidelity and do your digital custody there, but not for digital securities. And qualified custodian is needed if you are a real money fund in the United States. You want to access that kind of capital, you need FINRA and the SEC to figure that out. So what we did is we use MetaMask wallets, and so it's more of a decentralized approach where you custody yourself your securities. That's one way to get around it. And then the thought is, well, that doesn't sound very secure. So we did it with an ERC 1404. And the nice thing with doing an ERC 1404 is if you lose your MetaMask wallet, or you lose whatever wallet you're holding it on, that's fine. We can revoke from that and we can issue on another one. Because as the SEC kind of explained to us, you can't lose your 401k in a boating accident. And so if to get around custody, I guess we worked with the right kind of smart contract whereby we made it such that it's almost unstealable, the actual token. And so custody becomes less important. But this is kind of how the infrastructure is changing. It's almost like the way that the rules are set up in the US, people say we can't work with the reg, but you can. You just have to find a way to thread the needle. And it may not be advantageous today compared to, let's say, the national system and how things are set up. But I'm guessing when Henry Ford came out with the first car, there probably weren't that many gas stations, but it didn't mean that he went out and bought all the blacksmiths. What I'm saying is that sometimes you come out with a new technology and you just have to drive your own path, and you can't rely on the path that was used in the past, because soon it's going to be in the past. So I think Coinbase was asked once when they got that 100 billion valuation, would you buy the New York Stock Exchange? And it's kind of like asking Henry Ford if he'd buy blacksmiths. Why would he? It's a new technology. And this is how things are driving forward. But I think a lot of folks get tied up in the way things are done today without realizing that we're trying to change that paradigm.
I'd say on that we're going to Mark's point, we've got to have interoperability in terms of coexistence of TradFi and the new stuff. What we're able to achieve here with SDX recently with the bond issue and having a digital CSD and a digital exchange meant that underneath the hood, the banks could distribute product to their customers without having to do anything massively differently. So I think to Mark's point on evolution, that's exactly the kind of situation you kind of like, that says we'll let some of the things exist as they were, and we'll change some of the parts so that we can take steps forward. And I think as we see more issuance of securities tokens, particularly in the debt markets here, and our debt markets are probably, I know Henry made the comment about will you get 75 basis points. Debt markets in Europe are slightly advantageous for new products because we've got negative interest rates, which of course you guys don't suffer in other parts of the world. And there's you can see a big tug of war between clients and banks at the moment. Wealth management clients go to the bank and say, why am I paying negative interest rates? It's like, well, yeah, because we have to pay them too. So they're looking to replace cash balances with securities. So you need some kind of short-term financing instruments, back to the thing that Mark alluded to about commercial paper that feels like it's not such a long-term investment that you wouldn't do it now and give it a chance. So as you see some of these things coming together, I think that coexistence allows us to take some small steps in there, because the banks aren't going to throw out all this infrastructure overnight.
But Olaf, what about the point which Lars was making about building bridges? And in fact, we've had a question from a member of the audience, Anton Grin, who says it's a question for SDX, but others can comment as well. What about sooner or later plans, technologies, bridges from securities to CBDC to asset tokenizations, DeFi, crypto? How do you link these presently siloed markets up? Henry talked about this, Douglas talked about this, about how crypto is a natural source of liquidity for security tokens. But how do you make it happen? How do you build bridges? What are you thinking at SDX, Olaf?
Well, so there's stuff that will be issued natively. Then you can go and look at other bonds that have been issued and say, hey, can we make them available on another exchange? That's one possible bridge, that you go and collect up instruments that have already been issued. So I think I think Douglas at the beginning talked about an equity for token swap, that you take the old instrument, turn it into a new one, put it in a new marketplace and try and give it some sizzle that people will trade it. That's one way. And the other one is the one I was alluding to, that you take an instrument that has been used a little bit, like commercial paper, short-term funding, but to a narrow audience, and you put it in a new marketplace, make it more widely available. On the link to CBDC, yep, if CBDC comes along, then inherently you will have marketplaces, custody, means of payment, and you're going to need to connect up those three things. It seems like the central banks will focus on wholesale CBDC, which will be a good thing. However, they need to do a lot more than just that. They need to change the access rules. They need to deal with all the cross-border issues, and then it starts to get very useful in terms of single pool of liquidity, cross-border collateral that's in there, and people may trade more when that happens. But I think we're a little ways off the wholesale CBDC part yet at this point.
Can I ask if there's a couple of questions here which makes me think that there's a technical issue here. Ralph Kubley asks, in order to understand the instrument of security tokens, I need to understand the cash flows. Where are the cash flows described? Takes me back to Paul Dowding's question about current blockchains being unable to record future dated obligations as payables and receivables because they're using these smart contracts. So a long-only bond is sitting there, the smart contract knows to pay the coupon, twice a year for the next 10 years. But it's difficult to value these instruments if you automate that process of it. I think that's what Paul is saying, and therefore it's difficult for people to trade them. It's difficult for asset managers to buy them because they can't work out the match with their portfolio, which was a point Andrea Tranquillini was making. Asset managers need to buy assets which match the risk portfolio, match their liabilities, basically. And that, again, depends upon the secondary market valuations. Is there a technical problem here, actually, of valuing these things, but you can't see or predict the cash flows? Mark, is there a technical problem, or is it just our audience is just wrong about that?
Well, it depends on the platform you're using. Yes, there's a technical problem if you're using Ethereum or Solana or something like that. No, there's not a technical problem if you're using a platform that's designed to do exactly that, right? So we call it complete replayability. So issuances that occur on a blockchain in which you can do a direct issuance and then store the information about the security on the ledger while keeping it protected with cryptography and only allowing counterparties to that particular instrument to be able to decrypt the information about the instrument itself. So the commercial paper issuance we're doing, or the ABS issuance we did as a pilot with Ford 2 years ago, we actually published the full investment document onto the ledger. So I'm not going to pitch Symbian as a platform, but our platform does have the ability to store all data on the ledger rather than just simply storing a hash. If you store a hash, then it requires that information to be stored off the ledger to a third party. That then creates third-party trust. And then you have to actually go to that third party to see what that instrument does, which is the question that's being asked. If you can store that information on the ledger itself, when you enter into a transaction, you then can decrypt the details of that instrument, see if that instrument fits your portfolio, see when those cash flows will be paid and how they'll be paid, and then negotiate on a bilateral basis to trade that particular security. So when we think about trading of these instruments, I think they're going to start first on a peer-to-peer basis. We think the best instruments to trade first as securities are naturally OTC, and ones that are currently in markets that use phone or other type of messaging system that isn't completely electronic. Because to deploy a fully electronic solution into a marketplace in which you have competing entrenched solutions makes it extremely difficult. So if you find areas, again, like ABS or commercial paper, which they're pretty much manual processes, and make them digitized, you bring value, and you don't have any disruption of moving systems out in order to be able to implement new systems. So, but to answer that question, yeah, if you store the information on the ledger and have complete replayability, you're fine. And if you don't, it creates a problem.
Now we've had Henry, perhaps I could ask this question to you. You said a few minutes ago that if you're under 18, I think it was 100% of your investment portfolio is in NFTs. Mike Housel has sent us a question. He's sent us a link to this story about a young man in Indonesia who posted 1,000 photographs of himself on OpenSea just for a laugh and pitched them at $3. They're now selling at $12,500. So he's kind of become an accidental millionaire. Isn't this exactly the type of thing? On one hand, you could see the growth in NFTs over the last year or two as being very positive for the security token markets. But on the other hand, if something goes wrong here, it could become an opportunity for regulators, far from making these markets, writing regulation, make these markets work more easily, could actually stop them before they've even really got going. Do you ever worry about that?
I worry a great deal about the fact that for a lot of people, and again, under the age of 25, a large portion of your investable portfolio in places like Singapore, Hong Kong will be in NFTs. I worry about the fact that people do not know what they're actually buying. I think NFT as non-fungible token, distinct from fungible token, the technology makes total sense. And the idea of using NFTs to represent certain kinds of assets that should not be intrinsically divided, like land title, makes total sense. I don't think the average person has any clue what they're buying when they buy an NFT. And the fact that you label it using the technology is worrying in and of itself. That's like saying, hey, what did you invest in? And you said, oh, I invested in a stock. Which one? I invested in a stock. No one is looking through the underlying asset layer. We should be calling these things art tokens. Not least of which is because I don't think people realize there's often no legal or contractual link with any kind of underlying asset it may represent. But I think you bring up a really interesting point, which is, I think, Douglas, you mentioned the Coinbase listing earlier. OpenSea announced a few weeks ago that they are pursuing an IPO in the US. The fact that you have all of these major crypto platforms looking to list on traditional markets, on national security exchanges in the US, to me, the answer to at least the mainstream thrust of security tokens lies in trying to understand why that is the case. I think that maybe just a bit of definition, people can and will apply various kinds of blockchains, public or private, and tokenization to a lot of asset classes. In many cases, this is going to be done by effectively trying to digitize existing systems and workflows. The ASX in Australia is a great example, trying to swap out the backend settlement system for something based on the blockchain. We'll see how that all works. But that's really more of a digitization of workflows. What I think crypto has shown, and again, really should be an unignorable fact at this point, is that there exists the possibility of a radically different paradigm for how people begin to think about, let's call it investing. And I won't get into the semantics of whether or not buying a non-security or NFT is investing, but just how they're choosing to spend their capital and hoping to make some kind of financial return. Crypto, I think, has shown us that capital markets can and will follow the exact same business models that every other industry in the world is following. So when you look at the way that, people sell shoes online these days, it's all B2C. I go direct to consumer, I communicate direct to consumer. I don't need to usually deal with layers and layers of intermediaries. And I want to be able to touch a consumer that in some way is intrinsically interested in my product, meaning customers don't walk into a department store anymore and buy a shoe just because it happens to be there. They can find whatever shoe they want to buy somewhere in the world and buy exactly that. And you can probably tell I don't buy a lot of shoes because I have no idea how the shoe market works. But again, the fact that people like Coinbase or OpenSea are even thinking about listing on traditional stock exchanges using paper shares after having raised private VC money, even over the stern objections of their own communities. When Coinbase did the listing, when Open Finance is looking at doing the listing now, there's mini community revolts where people say, what are you doing? You say tokens are the future. Where's yours? Again, I think that until you talk about market issuance, Dominic, until you see a major crypto company want to actually tokenize their shares directly and choose to list digitally instead of using paper shares, you will not see mass adoption of security tokens. To be very transparent, Fusang, yesterday, sorry, everything's blurring a little because it's been a busy period, but yesterday morning, we announced that we'd received approval to do an IPO for ourselves, for our own company. And to me, the interesting point, or at least our very unique view, is that the tokens we've issued directly represent shares. So these are not tokens that map to a paper share somewhere else. These are not investment contracts or derivatives. The token effectively represents the share certificate, and through the blockchain record, we construct the register of members of the company in real time. So if you're a token holder, you're the direct legal shareholder in our company, as you would have been if there were paper shares. Again, I think this is a rather unique view, at least in our market. I hear a lot of people on one hand in the crypto market saying we are moving to a post-security world. No one's going to buy equity in companies anymore. And I think that's nonsense. But on the other hand, I also think that we do need to move away from just trying to digitize traditional capital markets flows. We do need to rethink how that actual infrastructure works in the first place. And as I said, I think the answer is in trying to blend traditional securities in the sense of, I think the first things to be digitized are shares, bonds, funds, just very simple, very straightforward, straight equity with no complexity, easy to understand, has to be equity in exciting companies, but blending that with understanding how crypto works, trades, and how communities are built. Or at least I think that's our view, right? And one view going forward. Again, I get that the US is a lot more complex, I think, than some jurisdictions out here in Asia. Maybe just one final thing. I actually think that some of our advantage in Asia comes precisely because some settlement infrastructure is so antiquated. So the DTCC in America, I think, is actually already an improvement over a lot of Asian markets. You have countries like Hong Kong where companies have to have physical paper shares. I don't think people realize that. Stamp duty in Hong Kong is stamped with a chop. And until you stamp an instrument of transfer, title does not transfer.
From the post office. You have to get it from the post office, Henry. You have to get it from the post office.
And then we know these things well because some other group companies do this for business. We run companies, sectorial firms. We run 8,000 Hong Kong companies, I think. And actually, because of that infrastructure, I think we've almost been forced to just totally leap to rebuilding that market infrastructure from scratch. So I completely agree with what Mark says. I do think you need a stock exchange, right? Or the equivalent of what America called National Securities Exchange. You need to have a venue where you can actually take companies public, and all of that sort of regulatory process and even the instrument you're tokenizing like a share. Honestly, I don't think that's where the innovation should come. I think the innovation needs to come in terms of how you face off against your customer, how you provide the same customer experience that people are used to from Amazon. And I really think you need to make it as easy for people to invest into a company as it is to buy their products online. Otherwise, I'm not entirely sure where the innovation is.
Yeah, we built a platform for HKEX in 2016 and competed with multiple others to deliver a private market solution to hang off the exchange. We were forced to be able to create a certificate that's printable from the ledger. So we did that. You literally could pull up a full stock certificate and the smart contract populated it for you. Then you would print it with the hash at the bottom. So cryptographically, you knew where it was in the ledger. The post office had to run a node in the network, as Henry said, because everything requires a postal stamp, which is analog. So we had to find a way to electronically do all that, right? And then to be able to then access a market in which there was an unknown supply of issuers. And so after we did all that, we won it. Then HKX said, "Yeah, we're not going to do that now. There's no market yet, and it's too difficult." And we moved on. Now in 2021, they started again looking at the market in a new way. But yeah, every single geography creates its own issues. I really think that looking at the crypto market is not the way to look at it, because the securities market isn't going to be the crypto market. And I think Douglas is exactly right. We have to build something new and innovative that addresses the securities market, but it has to all be within the regulatory paradigm, because regulated entities must participate, right? When we use the word security, what you're saying is that there's a regulated infrastructure that has to go along with it. And you're not going to convince traditional regulated entities, especially custodians, and we work with a lot of them, to go all in on something in which, from a regulated perspective, could ruin them. And so you have basically a standstill by all the existing institutions, and then you have all the new ones like Douglas doing all the hard work and building it out and trying to make a new solution. So it's not an easy problem. It's not going to get any easier anytime soon. The technology is there. To me, the one word is will. What entities have the will to now take this forward as a new market? And I think we don't have enough of that yet.
Which issuers, which issuers and which investors and which DLRs, which trading firms. Unbelievably, we've already been talking for an hour, and I still feel we're skating on the surface of all this, but I'm happy to run over for 10 minutes or so, because it's a very interesting discussion. And I'd like to end really by asking about this point about regulation. But before I do, Douglas, could you just, and this is related to the regulatory point, Anton Grins followed up and he says, well, this isn't just, this is the guy who was talking about building bridges between crypto, DeFi, security tokens, and so on, CBDCs. He says it's not just, it's about technology of liquidity bridges. You know, in the way that DeFi is working, or could work, that you could issue a security token that could become pledgeable as collateral inside a DeFi liquidity pool, for example. Do you think that there are purely technological ways of starting to generate liquidity in the security token markets by linking up with the cryptocurrency markets and with DeFi, or do we kind of have to wait for regulators to make clear we can do that?
Well, DeFi is a dirty word when it comes to regulation, right? But I'd say that there's a lot of DeFi companies that are now coming to companies like mine and saying, look, we want you to whitelist, go through a KYC and an AML process, folks that then can come in, and then we'll do a pool of folks that have gone through a KYC AML within this DeFi area. And that's a little bit like how Bank of America is set up today, right? I mean, you put your deposit money in, and then they lend it out to someone that's completely anonymous to you at 15% on a credit card. So it's like a centralized, decentralized way, except the difference is you don't get that 15%, you get 0.2%. DeFi works very, very well, but it's strangers dealing with strangers. And I think it's going to be very hard for someone like myself to get involved there, other than on a KYC AML type thing. But DeFi is good in the sense that you do the custody on your own wallet. So I like that. But I think that it's going to be very hard to also take a security token. If you're doing like a public security token, you're probably going to have it on a whitelist, because you're not going to allow it to be sold to random people. Every single person has to go through a whitelisting process. And so DeFi has a tough problem. If you put your ERC 1404 into a DeFi thing, you say, okay, I want to sell it to some rando. That rando also has to have gone through the whitelist process too. Now it can certainly happen, and that's fine. But it happens very, very few. DeFi is successful because it's strangers dealing with strangers all around the world constantly. When it comes down to security tokens, whitelisting is going to be very, very important. And it wouldn't surprise me a couple of things. One, if the US government says, look, if you want to hold crypto and trade crypto, you've got to whitelist your wallets with a registered exchange, whether it's a securities exchange or a crypto exchange in the United States. Because the US right now sees, they don't have a problem with Bitcoin. They get a problem with people having Bitcoin in wallets that they don't know about. It's like Swiss bank accounts to them. It doesn't really work for the tax guy. The other thing is NFTs over $10,000. I think there's going to be a crackdown there, because the old days, if I wanted to move $50 million from Colombia to the US, I put it in a plane. And it was hidden. These days, I do a squiggly JPEG, create an NFT, and then bam, the 50 million's in my pocket, and I can sell the government. This is how I got it. I made this painting. And so, there's going to be NFTs today remind me of 2017, the ICO phase, where it's crazy, it's exciting, everyone's talking about it, and then it just kind of blows up, deflates, and then regulation comes in and sort of starts to build it back up again. So, I think that what you have to take away is that regulation, whether you like it or not, certainly in the United States, is here to stay. You can't, this isn't like the Facebook model where you go out there, you break it and then you fix it. When you break it with the US government, when it comes down to financial regulation, it's really hard to fix it again. Now, it takes patience. You got to be a tortoise. You can't be a hare. But, as you build these different building blocks and you start to create an ecosystem that all is within the regulatory structure that exists today, then I think that you end up with a pretty good sandbox. And I think that what you find is a lot of institutions in the United States did do the Facebook model. They ran out the door. As Gensler said, they're listing hundreds of tokens that they see as securities. And that's going to be a problem for a lot of guys that are very successful today. Nokia had a great phone for a while, and now everyone has an iPhone. I remember using Netscape as a kid at Carnegie Mellon. Nowadays, everyone uses Google. Like, there's first movers that go out the gate. Everyone thinks you're never going to get past them. And then, moods change, things change, and suddenly the also ran becomes the big player. And but you've got to stay within the regulatory structure. And I think that regulation's moving towards companies like mine. It just takes patience.
Okay, now we've run over time here, but let's end the discussion by addressing this regulatory point. You've made some very apposite points about it, Douglas. Maybe I'll ask each of you to give us some thoughts on regulation. We've had questions from the audience. Mike Halsell says, how can regulators be brought more up to speed and better able to provide suitable regulation? Michael Christiakevitz has said, in terms of regulation, what are your thoughts on the DLT pilot regime planned for market infrastructures in Europe? Andrea Tranquillini says the DLT pilot regime is a business inhibitor, though I do agree with the ambitious path set here. Regulations like the sun, you see it every day, so there should be a way to go around it or reshape the market, as one of the panelists seemed to indicate. So people recognize regulation. And what my question, I suppose, is this. There's a kind of sense in which the security token market is waiting for regulation to catch up with it and say, it's okay, you can do this, you can do that, and then everyone's clear, issuers are clear, investors are clear, traders are clear. On the other hand, if something goes wrong here and the regulation becomes very heavy-handed, it could cast a blight over this market, and maybe the market never gets going because there's been some expensive accidents which have cost investors money, and the regulators kind of advertently or inadvertently stamp it out. So, Olaf, perhaps I could start with you. Regulation, because Switzerland has passed token regulations, token laws even. And tell us about the Swiss experience and whether you think that has relevance for the rest of the world, including the United States and Hong Kong.
So yes, we've been pretty good with the DLT securities laws, which really say, hey, you can issue stuff native to blockchain, and that counts as a security. You don't have to get your chop out and go down to the post office and do all of that. So far, that hasn't particularly led to a rush of issuance, really, in the sizzle type stuff that Douglas was referring to earlier. So that per se hasn't massively changed the way that securities are issued. So I see more prospect coming from that new instrument type of area, like commercial paper that we talked about earlier, that those will be used. I don't think yet that the law change has massively changed behavior.
Lars, is regulation an inhibitor for people like yourself? Do you like cryptocurrencies because they're unregulated and feel cautious about tokens and DeFi because they attract regulatory attention?
Well, I wouldn't say that, exchange tokens and crypto coins are not unregulated anymore. We have to be registered on the UK FCA, the crypto asset register. And I think the smoke from the consultation papers from ESMA and also the recent, consultation from the FCA is that it will probably be more and more aligned with standard regulatory frameworks. And again, coming back to the original security token consultation paper, I think it's pretty clear that they see it, it's hard to think of a security token that is not deemed to be a MiFID instrument under the current regime. And that's also why, as I think Douglas said, that it's the work to get it approved is the same as a traditional instrument. Again, I can only refer to the UK and the EU, my two home regulators, and I would say that they're not making it easy. So I think I'm sure there are other regulators out there, I think in Hong Kong, Singapore, and elsewhere, where they maybe have a more light touch approach. And I also think this whole NFT frenzy that we have seen probably is primarily taking place in Asia and to an extent also the Middle East. Again, I simply don't think I would not take the risk with the current regime in Europe, at least. I would get need to get clear guidance on each NFT. Would it fall under the security token camp, or would it be a utility token? Utility token, I would actually be somewhat comfortable working with and trading, but the ones that would just have a slight hint of security token, I wouldn't touch. I simply could not take the risk. And I think for the people that on this call that really have security token issuance and distribution for as their main business, I really hope for everyone that the regulators kind of will talk to you and listen to you and to make it easier, because it really deserves. I really think that this is the future. I think even though today, I think Henry as well, we probably make a lot of money and we have a good living of Bitcoin and exchange tokens, but I really think that the next wave will have to come from the security token space. But I'm with the regulators that I'm working with. I can't see we're there yet for this breakthrough, unfortunately. But I'm really looking forward to it, because it will also benefit my business immensely.
Can I just clarify something with you, Lars? You're saying that the regulators in the UK in particular haven't made treatment of NFTs, for example, clear, but are they being responsive when you say we'd like to trade these things, but we need some guidance from you, and you're not getting that guidance?
I can tell you at this point in time, I wouldn't even dare to ask them.
Mm-hmm. Okay.
So just stay focused on what you do. Make sure that it works within the existing guidance and framework. I'm not going to be first mover on asking them for anything.
This Douglas, is exactly what I was concerned about. That the regulator creates a climate of fear in which nobody does anything. Is that a risk?
No, I don't. Well, it's a climate of fear if you've already been caught with your hands in the cookie jar. But it's not a climate of fear if you're genuinely interested. I mean, we spent 950 days with the SEC because when you do,
that sounds very expensive, Douglas.
And it was expensive, yeah. But when you do normally a prospectus in the US, you copy and paste, if you're a fintech firm, the risk factors from the one that just did the IPO before you. It's all copy paste, and 90 days later, here we go. Nothing that we had in our prospectus had ever been defined before. And so we spent a lot of time sitting there and discussing through what is a blockchain, what is a smart contract, what is a wallet. Now, I think
educating the regulator.
But you have to in this space. You have to, because as soon as a regulator's educated, guess what? They get hired by someone else. They get hired by the private sector. And so you need to have patience. You need to, because just because you understand blockchain doesn't mean that the regulators do, and they haven't traditionally hired from that area. And so you have to be patient. But I think that if you do sit down with them and you do talk to them and you're very patient, then you do get the results. But I think that there's a lot of folks that don't want to sit down with them because they fear that they're going to get fined. Now, that'll happen if you've already been out there doing business. We kind of talked to them all before we went out there to do business.
Mm-hmm. Mark.
But I don't think that Lars is coming from a point where his hand's in the cookie jar.
No.
Lars focused on a specific thing. You throw NFTs in there, why would he bother?
Exactly, and Douglas, I completely and I'm not saying anything negative about any regulators, but if you spend 900 days on something, and I appreciate it, I guess I'm one of the smaller guys on this call, so I have to kind of wait for someone else to do the first move and kind of clear the path. We have actually responded to a number of the consultation papers, and we actually in the process of getting a license in the EU via Denmark as well, where we're also participating on some consultation. No, we have not done anything that we shouldn't do. I can assure you, but it costs money. Of course, there's big rewards if you get it right by being first mover, as someone said earlier. But I'm just not that person, so I'm waiting for someone to kind of get clearer guidance, because I guess we can agree on. It was even yesterday there was another consultation from the FCA on marketing or promotion actually of crypto assets. So the smoke isn't necessarily white if that's the right phrase, coming out is always a bit hazy, if you will. So I'm sure someone will clean the air before we move, and then we will have an easier living, because what we do today, yes, it's good business. You can actually make a good living out of it, and it's just a very narrow focus and a narrow path that we have to stay on to not do anything that we shouldn't do.
Okay, we're sort of about 15 minutes over, but I'd like a final thought on this from both Henry and Mark. Henry, it's probably getting a bit late for you, so why don't you go first and tell us whether you think regulation is going to cause a blight, or is actually going to be the factor which enables the security token markets to take off?
Since it is late, I'll keep it short.
It's only late for you.
I really enjoyed being
hours to go,
because very few people, I think, actually dig into a lot of the technical aspects of security tokens. So this is the best panel I've been on in a long time, I can say. But so I won't rehash what other people I think have said, and maybe offer something a little more thought-provoking, which is, I think the single barrier when it comes to regulation for security tokens is that there has not been enough willingness from regulators to regulate NFTs and ICOs, so certain types of assets. The honest truth is that if I am Aston Martin today and I want to fundraise, and someone comes to me and tells me that I can sell a picture of a car with no legal or contractual rights and no liability, and I can get money, it's awfully hard to say no to that. And so all of the promises perhaps that people were hoping security tokens could bring have been washed out a little, and issuers haven't come because they say, well, why don't I just issue an ICO or an NFT? And the honest truth is that, at least in most jurisdictions, enforcement risk on issuers is very, very low. In 2017 here in Hong Kong, the SFC were doing dawn raids on issuers' offices, shut down 2 people, and then it all stopped. And yes, there's a lot of focus today on regulating intermediaries, which is what I think regulators know how to do best. But until they start looking at the actual asset layer and saying, hey, most people, when they buy an NFT, they think they're getting some kind of legal contractual right. They're really not. Is it really safe that people are investing such a large portion of their portfolios into art? Again, nothing wrong with you want to buy art, but is that a real investment asset? I don't know. And until they actually step in and are willing to enforce on issuers, I don't think you'll see the security token market really start to take off in a big way.
I agree, Henry.
Mark, because what Henry is saying is that bad tokens drive out good ones, if you like, or unregulated tokens drive out regulated tokens.
There you go. I wouldn't use good or bad because that's subjective, right? People are making money with these things no matter what they do. So I wholeheartedly agree with Henry in that the preponderance of money is flowing into that space, right? If you look at the VC dollars, you can see the massive amount of money flowing in that space and almost no money flowing into the security token space. If you think about the technology and from an interesting perspective, where this technology works the best is actually not in a singular non-intelligent token that just gets moved around for trading purposes. It actually works the best when there is some kind of sophisticated workflows that are involved in which you can automate those workflows. And something that then in turn improves the back office function or removes the back office function completely and automates the security through its life cycle. So you have savings there, right? And so when you think about infrastructure and savings and all those pieces, that's where this technology really shines, not in speculation. And so the reason the crypto markets are where they are today is because people don't want to trade securities. They don't want to be embroiled in the rules and regulations that prevent them from doing what they want to do. And it's sold as free market utopia. But we all know that it's not, because these markets are concerning, to say the least, and the way in which they operate and lack of infrastructure, lack of rules and regulations to ensure fair markets. But when you're in a global basis, it's easy to overlook $100 million hack in one wallet and another $100 million hack in another, and a fork over here, because here comes the next one that I can get 10x on. So I'll just cash that one out and go to this one and get 10x. That doesn't exist in the security token world. So the excitement, the sizzle, the sexiness, all the money is flowing into a different marketplace. And so when you stand still and say the rules and regulations are clear, right? This is something that's always concerned me about our market, saying that these rules are unclear. That's just not true. They're absolutely clear. The people saying they're unclear just don't want to abide by them. They don't like them. So they say they're not clear, but they are extremely clear. And it's been said over and over again how clear they are, which then freezes traditional institutions from doing what they know they should do, which is drive security token infrastructure. And instead, they're building infrastructure for crypto markets because, as Henry said, no one's enforcing. No one's attacking the crypto markets. To add crypto to your securities trading application is easier than issuing a security token and trading it. And it shouldn't be, but it is. And so when I'm looking at it as a business operator, am I going to build out a broker dealer for securities tokens, or am I going to build out a crypto trading application? Well, it's not even a question, right? The path to easy money is in the crypto trading application. So the things that we're trying to do as a group here, we're trying to reimagine common market infrastructure and reimagine global regulation and how we view securities in a fair and clearly defined marketplace. And that is a big issue when you're dealing with something that is very dramatically different, driving huge returns. And when the asset class's value proposition is speculation, and that speculation continues to prove to be valuable, as an institution, I'm better off investing my money there than taking this risk to say, yep, we know these are securities, we know the rules, and we're going to do these things inside that and risk being enforced against if we make a mistake, versus going over here where there's very little chance of enforcement and a lot of opportunity to make money. So, this is going to continue until hard enforcement occurs in those markets, which then make people say, oh, wait a minute, I've been trading penny stocks without any kind of protection, and that's risky and I shouldn't be doing it. I'd rather have the protections of a structured market in which I know the rules and regulations and how the game is going to be played when I play it. And, I said early on in 2014, 2015, there won't be an Uber event in this market. And I was wrong. There was an Uber event from a financial regulatory perspective in crypto, where the regulators basically just got run over. And at some point, it was too much to attack. And things like Ethereum were created as clearly a security, but they had to say, nope, it's not a security anymore because it's too big to fail. And that's the reality in the US around these very large cryptos. So we've got a lot of work to do. If we're going to build this infrastructure, you got to, take a lot of lumps and spend 900 and something days with the SEC like Douglas did. I don't even know how many days I've spent with the SEC starting in 2013 and all the way to today. I mean, starting with the transfer agent rule and moving forward. And then institutions and new associations like ADAM, of which I'm a founding board member, the Association for Digital Asset Markets, where all we do is communicate with regulators, global regulators, about the value of these markets and how they potentially could become the true new market infrastructure. But we've got a long way to go, and it's going to take a lot of will. And there's going to have to be some trigger for incentivization to drive how this gets built out, because the incentivization in the crypto market is undeniable. I can either run the infrastructure and get paid as a staker or a miner, I can trade on top of it, right? Or I can issue these things, with impunity. So with those as the competing for the capital to build this out, that's a hard competition. And we have to find incentives to drive these markets to grow from a regulatory perspective and fit and create the new paradigm as we scaffold it up against the existing one.
Thank you, Mark. That's a great note to end on. I'm envisaging in my mind a regulator climbing out from underneath the bus labeled ICA, which ran them over. And they're going to wake up and they're going to be both forceful and they're going to be entrepreneurial. And they're going to help these security markets, so security token markets, take off by getting that side of things right. But I think we really must stop there. We've run well over time now. I'd like to thank our panelists, Olaf Ransom from SDX, Lars Holst from GCX, Douglas Borthwick from INX, Henry Chong from Fusang, and Mark Smith from Symbiont. Thank you too to our audience for your questions and your comments. Here at Future of Finance, our next webinar is on Tuesday, 10th of February. In it, we're going to be asking why all the investment and all the so-called innovation that's been going on in making payments more efficient has amounted to so little. Whether what we need is not more payments apps and more payments billionaires, but actually something genuinely innovative. That's multiple forms of money. I hope lots of you will be able to join us then. But for now, it's goodbye from the six of us.